Impending doom for crypto? Regulations incoming. There's no denying that the crypto market has had a terrible time in 2022. With the most popular cryptocurrency, Bitcoin, losing more than 50% of its value from 2021, Bitcoin fans are as sad as my friend after his first breakup. But considering that crypto regulations are on the way, Bitcoin and all the other cryptos will rise in value because it'll help reignite the trust in crypto. It's tough to tell where things will go in the long run, but in the coming months, we'll be keeping an eye on things like regulations and institutional acceptance of crypto payments to get a real sense of the industry. Speaking of getting a sense of the industry, click the link in the description box below for our intensive crypto course to hone your crypto skills. Although it's hard to tell what exactly is going to happen, we can make educated guesses about the future of crypto by looking at the positive and negative developments in the industry. So without further ado, let's dive right into today's video. Can regulations for crypto restore trust? Well, I don't know about trust, but they can definitely make crypto safer for investors and less interesting to hackers. US government officials have shown a strong interest in stablecoin regulation in particular, thanks to the Terra Luna meltdown, which set off a chain reaction that gave federal authorities a reason to fight for crypto regulation. While there's still more work to be done, there has been major policy progress this year. And if you'd like to catch up on it, watch our Crypto Weekly update by clicking on the banner. It all started in March, when President Joe Biden issued an executive order directing federal agencies to explore the responsible development of digital assets, such as stablecoins, and that's what has accelerated all the progress that has been made lately. Regulation, unfortunately, has hurdles, like the majority of things related to cryptocurrencies. Since US firms and investors are currently operating without clear guidelines, explicit regulation could mean the removal of a major roadblock for cryptocurrencies. So what impact would these rules have on you as an investor? Well, even though the subject of cryptocurrency regulation is usually controversial, most people think that it'll benefit investors, the crypto industry, and possibly people who are into international transfers with crypto projects like Ripple. If you'd like to know more about Ripple, check out this video. So how exactly will regulations help? For one thing, regulations can benefit the extremely chaotic cryptocurrency industry by increasing market stability and hopefully the trust that the industry has lost thanks to Terra Luna. Second, it'll give the crypto sector the power to protect long-term investors, stop fraud in the crypto ecosystem, and give companies clear guidelines to promote innovation in the crypto industry. Does this mean you should invest in crypto? Well, not exactly. But even if it doesn't make sense to invest in cryptocurrencies right now, the adoption of cryptocurrencies by more businesses might change this in the future. We're still a long way from the day when using cryptocurrency to pay for goods would be a smart financial move, but institutional adoption could create new uses for normal users and influence cryptocurrency prices to get us out of this crypto winter. Nothing is guaranteed, but investing in cryptocurrencies as a long-term store of wealth increases the chances that demand and value will rise as more real-world applications emerge. The same thing applies to NFTs. People are still confused about NFTs and whether or not they're here to stay. Some consider them a scam, while others argue that the smart contracts on blockchain technology that drive NFTs offer benefits that no other product or service can. There are some NFT projects with varied functionality like gaming NFTs, but what do you guys think about NFTs? Are they a scam? Let us know in the comments. According to some research, the NFT market has had its time in the limelight as a one-hit wonder, like an artist who releases one extremely successful song before they disappear into thin air. Last year, countless people bought NFTs as investments or purely for fun because all the celebrities were doing it, especially Bored Ape NFTs, which were all the rage. Whatever the reason, the crypto winter has dramatically reduced the value of many of these digital assets, so it doesn't matter if Justin Bieber or Eminem has one anymore. What you can do is use the volatility to play a steady long game with Bitcoin and Ethereum because these coins are literally on a Black Friday sale right now. If you're looking for long-term growth potential, you shouldn't be concerned about the short-term fluctuations we've witnessed this year. The best course of action is to set it and forget it, and stop thinking about your crypto investment. Although we can make educated guesses about the potential value that cryptocurrencies may have for you in the months and years to come, keep in mind that cryptocurrencies are a relatively new type of investment with no performance records to make judgments from. No matter what a specialist or a prediction tool claims, nobody knows. Over the past few months, cryptocurrencies have taken a harder beating than your little brother after stealing dad's special drinks. For instance, the price of the US dollar against Bitcoin went from about $70,000 in early November 2021 to under $20,000 in late June. And despite ups and downs, it dropped to $19,733 on September 15th. No one expected that. To forecast future possibilities for cryptocurrencies, it could be useful to look back at the past and highlight a few key points. For starters, the blockchain world is made up of cryptocurrencies and derivatives. Bitcoin, for example, is a cryptocurrency, but the stablecoins Tether and USDC are crypto derivatives. These are derived from cryptocurrencies or linked to a popular and centralized currency, like the dollar. In simpler terms, a financial investor gives money to a business in exchange for a derivative, and the business transforms the cash into cryptocurrencies before lending them to an international customer. The upside for this is that if you buy Bitcoins or other cryptocurrencies, you can profit or lose depending on the value of the cryptocurrency assets in your portfolio. But if you've bought a stablecoin, you'll realize that it's not actually backed with enough cryptocurrencies, or that the dollar convertibility guarantee is, to put it lightly, weak. If this is the case, the stablecoin ends up being almost useless. This is what happened with a number of stablecoins during the last several months. Companies that offer products like these are extremely active in the market and add to the volatility of the actual assets, especially if they promise high returns, which increases demand for cryptocurrencies and stablecoins. The fact that cryptocurrencies are regarded as both a financial tool and a store of wealth now, as opposed to a method of payment for daily transactions, is the second important point. For instance, more than 60% of all Bitcoins in circulation are stored in digital wallets, with more than 100 Bitcoins each, and they're rarely traded on the market to rebalance portfolios. Only roughly 250,000 Bitcoins were moved per day as of the end of July 2022, and it's possible that only a small fraction of those trades were for professional reasons. Additionally, those who own cryptocurrencies seem to have a long-term vision. For instance, all the loaded investors have bought coins while they're at their lowest values. In the end, regulation appears to be the best option for cryptocurrencies, so these types of investors don't create volatility. So can crypto regulations save the industry? Well, the head of the European Central Bank, Christine Lagarde, has stated that cryptocurrencies are meaningless and that regulation is needed to save new investors from losing all of their money. Oddly enough, central bankers also have digital currencies, which President Lagarde believes are totally different from cryptocurrencies. It's true that digital currencies issued by central banks are different from cryptocurrencies issued by blockchains, but not for the reason Ms. Lagarde has in mind. The issue she probably has is that decentralized currencies have the potential to absolutely decimate the idea of monetary policies and make central bankers a thing of the past. So it's easy to see why the world of central banking isn't crazy about cryptocurrencies and call them a scam. Central bankers don't exactly hate cryptocurrencies because they're scams. If they think that cryptocurrencies are a scam that are based on nothing, then all central bankers should be taken to court. In reality, the reason they're against them is that the adoption of cryptocurrencies challenges the privileges of central banking, which will have an impact on things like how public debt is handled, for example. Conclusion: regulating appears to be the most secure course of action in the end, where everybody's happy. The only real concern left for governments is taxes, because there's no serious risk to fiat currency otherwise. It has very little to do with the decentralized nature of cryptocurrencies, but everything to do with the fact that a tax collector has no way of knowing how much money a taxpayer has tucked away. But it's possible that regulatory efforts will focus on ensuring transparency in order to monitor and tax this type of currency if regulations do finally come, which they will. Thanks for sticking around. If you found this video helpful, be sure to like the video and subscribe to our YouTube channel for more videos.